What pay and dividends mean for company directors. Welcome to P.A.Y.E Experts Academy, for your entrepreneurial tips and advice. Do remember to subscribe. A lot of company directors over the years have been opting to take their salary in the form of dividends as opposed to being paid through the P.A.Y.E system. They have chosen to do this because with dividends payment, they are not liable to make payments for national insurance contributions, income. The amount of tax on their capital gains is usually also lower than income tax on the same amount. The directors do this to keep more of their profits in their pockets by paying lesser taxes. Is dividend payment better to pay for company directors? A company director should be careful because even though dividend might be a better choice in maximizing their profits, it could be a disadvantage if their business goes bust and they are faced with bankruptcy. There are statutory guidelines for paying dividends which a lot of the directors do not know about. There are unfavorable outcomes which may be encountered with dividend being the mode of payment. All directors need to be made aware of this in order to make the right decision. This video will first define the words pay and dividend before explaining the consequences of taking dividends as a form of payment. What is dividend? A dividend refers to a reward, cash or otherwise, that a company gives to its shareholders. Dividends can be issued in various forms, such as cash payment, stocks, or any other form. A company's dividend is decided by its board of directors and it requires the shareholders' approval. However, it is not obligatory for a company to pay dividend. Dividend is usually a part of the profit that the company shares with its shareholders. A company director is usually the number one shareholder of a company, either with 100% shares or with most of the shares. However, when directors choose to be paid through P.A.Y.E, they become employees as well. What is P.A.Y.E? P.A.Y.E means pay as you earn. This is a method of paying income tax and national insurance contributions. All companies deduct tax and national insurance contributions from employees' wages or occupational pension before paying them their wages or pension. A lot of directors do not accept to be paid by this method to maximize and retain most of their profits. The consequences of taking dividends as a form of payment. 1. There are some dividends that are deemed illegal. Statutorily, there are legal and illegal dividends. The statutory procedures for being paid in dividends are extremely complicated, to the extent that the average director or owner does not have the legal background to understand what constitutes a legal dividend and an illegal dividend. If a company goes bankrupt and any dividends having been paid are found to be illegal, the director will be required to give that money back. To alleviate this kind of situation, it might be advisable to take a director and officer's liability insurance that can offer protection against such claims if they as directors are found personally liable to pay back the dividends. 2. These illegal dividends must be paid back. Whenever a dividend is required to be paid back, the director is confused as to why he or she should be required to give the money back when by rights it should have been their salary or money they have worked and sweated for. Even though this is true, it is important to keep in mind that a dividend is not a salary for work performed in the strictest sense. A dividend is a percentage of the profits set aside for shareholders' payments. So, by requesting payment through dividends and not through P.A.Y.E, the director thus becomes a shareholder or member. 3. Creditors get paid first during bankruptcy. According to the insolvency statutes in the UK, creditors take front and center stage when it comes to being paid before or after a company goes bust. All shareholders, members, need to wait until creditors have been satisfied before any leftover monies can be distributed to them. So, if a director is being remunerated in the form of a dividend, they become a shareholder in the business. This makes them to get paid last and not first through P.A.Y.E. 4. Bankruptcy administrators hit directors with a loan account without having borrowed money. With this knowledge, it is now clear how some directors are surprised when they are informed by the liquidator or administrator of the bankrupt or failed company that they have an overdrawn director's loan account. Insolvency practitioners report that they are often contacted by these directors because they feel the administrator must be mistaken. To the directors of these companies, they never took a loan against the books. However, according to UK law, they did. So according to the insolvency statutes in the UK, any illegal dividends paid to a director is to be considered a director's loan and must be repaid from personal finances. In conclusion, this topic has explained what P.A.Y.E and dividends are for a company director, and the consequences of accepting payments through dividends. Even though a director might prefer to be paid in dividends as opposed to through the normal P.A.Y.E scheme, they should think about the consequences before choosing this path. Yes, the immediate benefits of higher pay through dividends are enticing, but what happens if the director's company should go bust? The question is, do the directors know what constitutes a legal dividend? Directors should make sure that they have their facts right before accepting this form of payment. Remember to subscribe to our channel and hit the notification button to be notified when we upload new contents.